Recently, Charlie Munger hosted his annual general meeting for the Daily Journal Corporation, and in the meeting, he was asked about thoughts of investing in China. And so that's what we're going to get into in this video. So guys, as you smash that like button, let me run that intro. What's up guys, and let's dive right into the question because I found it was very interesting as well as Charlie's response. So here's the video.
Just about China in general, I had a lot of questions that came in regarding that. I'll ask this one from Wilco Schutzendorf. It's coming in from Walnut Creek, California, who just said, previously you stated that despite certain shortcomings, China was generally moving in the right direction. However, with the recent actions taken by the Chinese government, such as capriciously punishing technology and educational companies, declining to import effective COVID vaccines, escalating threats towards Taiwan, do you still maintain that China is a viable investment option for foreign capital, or is China experiencing a similar regression as Russia has seen under Putin's leadership that culminates in the invasion of Taiwan?
Well, that's a very good question, of course, but I would argue that the chances in a big confrontation from China have gone down, not up, because of what happened in the Ukraine. I think that the Chinese leader is a very smart, practical person. And it doesn't, Russia went into the Ukraine because it looked like a cakewalk. I don't think Taiwan looks like such a cakewalk anymore. I think it's off the table in China for a long, long time. And I think that helps the prospects of investors who invest in China. And the other thing that helps in terms of the China prospects are that you can buy better, stronger companies at a cheaper valuation in China than you can in the United States. So you're getting, the extra risk can be worth running given the extra value you get. That's why we're in China. It isn't like we prefer being in some foreign country. Of course, I'd rather be in Los Angeles right next to my house. You know, it'd be more convenient. But I can't find that many investments, you know, right next to my house.
And Charlie's absolutely right. When I was investing, or when I started investing in China, the question I asked is, what are the pros and cons of investing in China? And, the major pro that I got was, ultimately the valuations. And then, of course, the cons was everything else that kind of adds up. There's the property crisis, there's dealing with the CCP, there's the US versus the Chinese yuan, like the currency issue, the RMB or whatever. And there's a whole slew of issues with investing in China that I do talk about on the channel, but we just take that into conjunction with the valuation that we're getting. And, ultimately, these companies are world-class. I would say the double dragons are definitely world-class, and being the double dragon meaning Alibaba and Tencent, and the valuations that you can get these companies at is absolutely mind-numbing. And so you guys know that Alibaba is still one of the largest positions in the portfolio, but I just want to show you guys something just to, hammer that point home of what Charlie's trying to say. So here's Alibaba, and you guys have probably seen this before. This is their revenue growth trajectory. And so in 2023, I expect revenue to go backwards. But the point that I'm making here is that Alibaba right now is trading at 17 times free cash flow per share net of stock-based compensation. So, I bring down their free cash flow per share estimates by what I'm forecasting them to dilute their shareholder base with that stock-based compensation. And so, it's a lower numerator, and yet still I'm getting to only a 17 times free cash flow per share net valuation. And, that's happening on a company that has an absolutely wonderful growth profile. Like you can see here in the next 5 years, it's very likely that total revenue is going to be growing at approximately 8%. This is not a forecast, it's not a recommendation for you to buy the stocks or anything. This is just an idea of how I'm seeing it, right? And there's a lot of areas for outperformance. For example, look at how slow I'm growing cloud, right? If cloud starts picking up at a much higher rate than this, which even they believe that it will, then, you can actually get a higher revenue growth rate. The other thing is I'm not growing out China commerce, their bread and butter, at a high rate at all. China commerce could absolutely grow faster than this. There's been years that China commerce has grown 40%. I think those days are behind them. However, I think 7.5% could be on the low end. So, at the low end, or at the conservative end, you have a company trading at 17 times earnings or free cash flow per share net of stock-based compensation, with 7% or 8% of revenue growth ahead of it. That's how crazy cheap it is to buy companies in China. And I'm not done there. I want to show you Tencent as well, because Tencent is also very interesting in this environment. And it's also something that's down like 20% over the last month or so. So here's Tencent. Once again, this is the model that I have available to the Patreons. And so, Tencent is trading at 20 times free cash flow per share net of stock-based compensation. So that same sort of penalization that I give Alibaba, I also give to Tencent. And, it has an even higher growth profile. And I also believe that the industries that Tencent is in are much more future industry focused than even Alibaba, because Tencent is very much a digital business. And so, you can see here that even when I'm being super pessimistic, I still am forced to grow Tencent's revenue out at double digits, albeit the low double digits. But, do you think that online advertising could pick up to more than just a single digit growth? Absolutely. Do you think social networks and gaming could grow out? Well, I would think that gaming is going to start growing out once again. The CCP got involved in it and slowed it down, but I think that it's just going to start going back to the growth rate that it was experiencing. And, Tencent is so strong in the gaming space. This is why Microsoft is looking to buy Activision, just so that they can compete with Tencent in the mobile space. And what do you think is going to happen in the mobile gaming space? It's only increasing. So Tencent is very future focused, and yet despite that, they're trading at 20 times earnings. And so this is the crazy low valuations that you can get by investing in China. Once again, that's not a recommendation for you to buy these securities. Always talk to your investment advisor. But the point that I'm making is I wanted to prove mathematically using my analysis that Charlie Munger is right when he says that these valuations are low. Now, I want to know what you guys think about the valuations in China. And the other thing is, if you want access to these two models that I just showed you, you can get access to both models at that lower tier of the Patreon, because that lower tier gives you access to all my models, including Alibaba, Tencent, Google, Meta, H&R Block, home builders, etc. It's all there. I think it's the greatest, or I would say the best value on YouTube. Now, the other thing is that if you've missed my recent breakdown of Alibaba's recently quarterly report, you can actually get access to that video series right here.